Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer and today I'm going to be taking a look at Equifax stock, ticker EFK. They recently experienced about a 20% stock decline in the past month or so. So it's kind of started to crash a little bit. And a lot of times when stocks fall a lot, it piques people's interest and they look at them and they want to kind of evaluate them. So I'm going to make this video to share my valuation of the stock. As always, this is not individual investing advice. This is just how I analyze stocks. I'll be using fast graphs for quite a bit of this. I do have a 25% off affiliate link down in the description if you've never used fast graphs before. It's pretty handy. I've been using it about 5 years, maybe 6 years now. And it's really useful for this type of earnings analysis and to look at the long-term history of earnings, which I think is important. So that's down there for you. And I also have a link over to Patreon. I have a free tier there now, and I post a lot of stuff over on Patreon as well. With that, let's get into the analysis. So the first thing I like to do is look at the long-term earnings history, which is this dark green shaded area here on the fast graph. And really, usually what I'm looking at are to see if there's a consistent pattern of rising earnings and whether or not those earnings are cyclical or not, whether they've experienced big drawdowns even though they've been rising. So if we go back to the Great Recession, earnings only fell like 7% during those 2 years. That's very low, so not very cyclical. Going into 2020, earnings fell again. This was partly due to a data leak and I think insider trading investigation. I don't know exactly what the results were that. I actually did buy the stock after this dip and held it for a little while and took a little bit of profits at some point along there. But I haven't owned it since then. Basically, it's just been pretty expensive since then. So, but they have recovered from that kind of snafu, and earnings rose quite a bit during the pandemic. But now we see that they're in a pretty significant decline. Probably the most, last year was probably the most that they experienced significant earnings decline that they've had in the past 20 years. So very kind of choppy lately, but definitely able to analyze, especially if the stock is trading kind of at the extremes. So let's look at the more recent data, since I think this recession data is important to know, but we'll deal with that later maybe. And we'll look, I usually start about 2015, unless there's a reason for me not to start there. So this will include a couple faster growth years, which kind of makes sense. Analysts are expecting this year and next year to be, I would always look at this with some skepticism, but you can see that the next couple years match this 2015, 2016 year in terms of their expectations. And then these years are pretty similar to what we saw during these 3 years. And then 2020 is kind of the only outlier in here. So this time frame seems like it's reasonable to use. The time frame is important because that's how we'll estimate future earnings growth based on this time frame. Fast Graphs has earnings growth coming in around 6.9%. I usually am a little more conservative, and I am just a little bit, almost the same though. About 6 to 7% earnings growth is what we're looking at here. So we have 6-ish percent, 7% earnings growth. If we expect that same thing to happen over time in the future, then we can use that earnings growth rate to estimate how much we could collect in earnings if we own this business for every $100 that we put into it. If we just look at the quick valuation, it's at a 31 PE. That seems quite high to me just off the bat with a 7% earnings growth rate or 6%. But we do see that during this time, it's traded at a pretty high PE for a lot of this time. A lot of people give me grief for not using the average PE button here. So we can do that and see that the average PE ratio was pretty high, about 25. during this time. Now, even then, it's still higher than that now. So if it reverted to the mean over the next year, you're looking at 191, and I think it's trading at 216. That said, we have had more inflation, so I wouldn't be surprised if they can have nominal earnings growth be higher than it has been. But it's, the real rate. Look, if you're growing earnings 6% in a 2% interest rate environment or inflation environment, and then you get a 4% inflation environment and you grow earnings at 8%, well, the real growth rate is still the same. But it's better than own a bond, right? Because that's not going to be able to adjust. So with inflation, whereas a good business can, and as far as I can tell, Equifax is a pretty good business. So really, it's just a matter of kind of running the numbers here and seeing what we get as our future earnings growth estimate. So go to the spreadsheet to take a look at that. So the way I do this is I have my earnings growth rate. I don't know how much debt they have. A little bit, it looks like. Yeah, about 20%. So I pull that from, let me go back to the fast graph here. So I look at the market cap, and then I look at the total enterprise value. I see how much higher the total enterprise value is than the market cap. I don't know if I updated this for the most recent price move, but it was about 20% higher the last time I updated that. So what I do is I add that 20% to the stock price when I'm doing my valuation. So instead of 216, I treat it as $260 stock price for the purposes of doing the valuation. So that comes in at a 2.92 earnings yield, percent earnings yield. So if we bought the whole business for $100, including the debt and other obligations, we would expect them to earn about to return $2.92 in earnings on that $100. I pull the first year growth forward, so this is looking forward to the end of 2024. And then I assume that this 292 will grow at that 6.21% growth rate, earnings growth rate, over time. And what I want to see is how much I would collect over time, assuming that growth rate in this starting point. Now, importantly, it's not the $103.10 here is not growing at 6%, just the $3.10 is. So that can throw some folks off sometimes, so I'll just try to point that out. So what I do is I go 10 years into the future for this particular analysis, 10 years. So our $100 would turn into $141.27 over 10 years based on the kind of owner's earnings accumulation, basically. So you can put that in a CAGR calculator, which my spreadsheet does here. And that gives you a 10-year CAGR expectation of 3.52%. To me, that is very low. Like I would feel pretty comfortable just selling this based just on the valuation. So because you can get 5.3% in cash, short-term cash, you could even get, now a long-term bond now is what, Treasury is 4.6% or something. I didn't check today, but so that has a higher yield. Now, like I said earlier, if inflation stays pretty high, which it looks like it is right now, then these earnings might grow at 8% instead of 6%, in which case this would be a better return. But again, you take on the risk of like a recession if you own a business or a stock like this. So we can go back and look. It's still not particularly appealing, but if you look at what happened during the Great Recession, the stock price fell more than 50%, and it started at a 20 PE, not a 30. Just during this little bust off of the pandemic boom, Equifax fell about 50%. So that wasn't even a recession. So granted, that is from more like a 38 PE or something. So, I think the downside from a 30 PE is easily 60 to 70% during a recession. And kind of that's what, I would assume that that is a risk that you're going to take with a stock that you wouldn't take if you're comparing it to like a bond. So if you're trying to do equal comparison of the times, I mean, this still looks pretty unattractive to me, because chances are we'll have a recession within the next 10 years for sure, but probably within the next 5, you know. So when you put this all together, if I was going to buy it with a margin of safety during a recession, I'd be looking at a price that's like 67% lower. If I just use the straight up numbers with a margin of safety, about 65% lower than where it trades today, even though it's sold off 20%, which is kind of why I wanted to make this video. Yeah, it's sold off a lot more than like the rest of the market, but that doesn't mean it's cheap. And then, so I did like a fair value, like the midpoint of fair value calculation, and that came in at about 102. And that is, I mean, where are we at now? We're at 216. So that's still a 50% decline just to get to fair value. Now, to point out the arguments on the other side that I think that they would make is, this is a really asset light business. People tend to like those a lot more. Also, they're basically an oligopoly with TransUnion and Experian. So you have 3 choices, and that's kind of it for credit reports. But I do think that the way technology is going, how much information people have on the internet about just their lives in general and their spending, there's probably going to be other ways to assess people's credit that might even be better than what the credit reporting places are doing, or at least as good, for less expensive. So I think there's definitely like a technological risk, even though these credit reporting places have, kind of been totally necessary for a long time now. I mean, at least 100 years. So yeah, it's pretty complicated, but my bias is always to be on the cautious end. So to me, a 30 PE growing at 6%, I don't really care if there's that much risk that their business is going to be disrupted. Even if it's not, those returns aren't very good, right? And the projected returns are not very good. So now, if this earnings growth rate actually comes in and the market is correct and they grow 20% a year for the next 3 years, then if they did it for like 10 years, then a 30 PE would be totally fine. You could do well with that. So I think what the market's doing is it's looking at these projections, it's extrapolating those out, and pricing the stock today as if that could go on for a very long time. If the market's right about that, then you should be able to get good returns from here. To me, that's just, I think it's unlikely. It's not something I would bet on, not at this price. So yeah, I think if you got down to closer to 100, maybe close to the bottom in 2020 was 103, you get down to like 105, I could totally see somebody maybe taking a chance just based on the way the market has treated this stock in the past. Might give it a little bit of a benefit of the doubt, but I wouldn't be stepping in at all before then. So that's my thoughts on Equifax. Even though it's down 20%, still not a buy. Probably still a sell, honestly. These numbers down here, like the 160s, look much more reasonable. 150, 160s for the stock to start trading at longer term, especially if these numbers get missed. So yeah, I think that's a pretty high probability downside. And then from there, it's just a matter of what kind of returns a person's looking for in their investments, and I want high returns, so I aim for low prices. Okay, hopefully you found this useful. If you did, hit the subscribe button, hit the like button, or drop a comment, and I'll see everybody later. Bye.